Hey guys, TommyBryson here, and I'm actually very excited about this video because basically when I first started investing into stocks, no one told me like the benefits of doing this investment method over this investment method. So today I'm going to tell you about 7 different ways to go out there and make money in the stock market. Now, by the way, overall, the stock market is just you basically buying shares of a business and then choosing to leverage and doing other fancy things out there. But overall, it's just buying shares and leveraging businesses and basically investments. That's all it really is, okay? But it's good to know exactly what the pros and cons are of doing each strategy and exactly which one is going to be best for you. Now, overall, out of these 7, there are only 2 that I actually do today and I actually recommend. All other 5 are ones that I find too risky and not actually worth my time and also worth my money and worth me going bankrupt over. So today I'm going to break everything down right here. Now, if you guys are new here, I post videos every single day, so make sure also subscribe and the bell to get notified, on top of that also destroy the like button. Now, the very first way to go out there and make money from the stock market is to go out there and short the stock market. Yeah, I said short the stock market. Now tell me, what exactly does this mean? Well, the idea is that all you're doing is borrowing shares, selling them for the market price, and then hoping it drops in price, that stock, that share right there, and then you buy them for a discount, return the money to the broker, and get to keep the difference. So, for example, let's say I want to short 1,000 shares of Tesla and they go for around $800, right? So that's around $800,000. That's a big bet, right? Now, let's say I did that, okay? And let's say Tesla stock actually crashed down by 50%, meaning I can go ahead and buy that same 1,000 shares for around $400,000 instead of 800K. So now I go ahead, I buy them at 400K, return them to the broker, and I get to keep the profit of around $400,000 just like that. Now again, it sounds easy, it sounds great, but in reality, if that stock keeps climbing up in value, well, you will have to replace all that money. And if things go wrong, potentially you could go bankrupt. And by the way, a stock can only go down to 0, but potentially it can keep climbing and climbing and climbing. So for example, you bought it for $800 per share, but now it's worth $2,000 or $5,000. Well, what do you do then? And on top of that, to make money in this game, you also need a ton of money. And on top of that, you need to be prepared for when you get a margin call saying, hey, the investment's going up, we need more money in the investment. That way, we don't go ahead and sell all your other investments, okay? So keep that in mind. Shorting a stock is actually usually not the best idea. Although it sounds sexy, it's actually pretty hard to predict when the market's going to crash, when the stock is going to crash, and potentially you can just keep going up and up and up and up. And then you have a big problem. Now, the second way to go out there and make money from the stock market is to actually start day trading stocks. Now, in normal English terms here, day trading is just basically buying and selling shares very quickly. Usually, you don't hold past 3 days, and most of the times, they don't actually hold past 1 day. Now, the big idea is this. People say, hey, I buy this share right here, I make a profit today, I have cash on hand, I keep doing this, and in reality, it sounds sexy also. But again, your information is coming from charts and it's also coming from high speculation. Again, you're trying to predict the market and trying to time the market. And again, we never know exactly what the stock market is going to do. And by the way, the stock market does not have to open tomorrow. That's actually a real thing. The stock market has gone around 3 to 6 months sometimes without actually opening back during the World War I or World War II. And you actually never know what's going to happen. So keep that in mind. So the whole idea is this. Day traders base their information not on the company and the value and so on, but it's just based on the price and also charts. And by the way, research shows that charts and trying to buy because the price was this and that, in reality, you might as well just be doing things randomly because that's how random your profits actually are. And 80% of them actually go ahead and lose money. But Tommy, I've seen a YouTuber actually do this. In reality, yes, but most YouTubers make money from videos, okay? Now, on top of that, they also make money by making courses on how to teach you how to day trade. So most of their money usually comes from not actually day trading, but from selling you courses on how to day trade. There was a big scam revealed by CoffeeZilla talking about, hey, these people were scamming the heck out of people by telling you about Raging Cow. You guys know about that. So it's a very big thing, but it's also very risky. I don't recommend it. On top of that, it's like having a full-time job with day trading, and it's not the best game because basically all the odds are against you. It's just not my game whatsoever. Now, the third way to go ahead and make money from the stock market is to turn $100 into $135 by borrowing on margin. How do you do that, Tommy? The answer is, if you have a portfolio, for example, a 100K portfolio, you can actually go ahead and borrow up to 35% of portfolio, sometimes even more with the broker, and then you grab that 35K, right? You grab that money, you buy more stocks with it, or for example, you grab that money and invest it for a down payment or whatever you actually want to do. But if the stocks actually go down and down and down in value, they will go ahead and sell all your investments to replace the money you actually owe the broker. So on top of that, they make money from interest. They actually charge you. And if you don't pay, they go ahead and sell all of your investments. Again, the broker never loses money unless it's a big client, and then it causes the broker to basically go broke, and then everybody else suffers. Okay, that's a real thing, by the way. It's happened in the past. But borrowing a margin, usually the common rule is this, okay? Well, when the stock market is down, you borrow a margin to buy for a discount. But when the stock market is up, you go ahead and you pay back the money you borrowed. That way, everything goes back to normal. But if it crashes all of a sudden, what do you do then? If you don't have money to replace the money, you actually owe the entire broker. It's a big problem, and I never borrow on margin with my investment, and neither does Warren Buffett. And most of my advice comes from Warren Buffett because basically, that's one of my heroes right there. And also Charlie Munger. Now, the fourth way to go out there and make money from the stock market is to do value investing, what I basically do. Now, the idea is very simple. You have to create a storyline for the stock and only sell the stock when the story basically changes. That's according to Peter Lynch, one of the best investors ever in history. And generally, guys, okay, as a value investor, you have three things to worry about. The first thing is, when you invest into a stock, you invest into a company, not just a tinker symbol or a little blip on a screen. So the idea is, if I want to buy Tesla, the stock is going up, great, but what about the company do I actually like? The company itself, not just Elon Musk, but basically, what are its assets, its competition, its management, its employees, its sales? How does the company actually do? And health-wise, okay, that's what you want to look at. And then you want to look at the assets and compare it to, hey, how much is the company actually worth per share, not just the market price. And then you can actually invest based on facts and not based on, hey, all the hype actually going around Tesla these days. And second, whenever you buy a stock, you want to make sure you don't lose money. Tommy, how do you do that? The answer is, whenever you buy a stock, you want to buy it with a margin of safety. So for example, if you do all the math and it turns out that Tesla is actually worth $100 per share, well, you don't buy it $100 per share or $110, you actually buy it for a discount around $80 or $90. That way, you have a little cushion there of 10 to 20%. That way, if anything goes crazy wrong, you have a margin of safety to go ahead and sell if you made a massive mistake. And lastly, what you're looking for as an investor, number 3 here, is to go ahead and compound your good results. Don't go out there and take a bunch of risks, and before you know it, yeah, you make some money this year and the next year, but before you know it, you take this big risk and you basically lose all your money. Compound interest only works when you don't make massive mistakes. So for example, whenever I buy a stock, it takes me months or, for example, hours to research, and then when I buy it for a discount, and I also focus on, hey, how can I keep making secure money to keep going ahead and compounding my results and not worry about making a bunch of money tomorrow or the next day. It's all about steady results and turning money into more money, but patiently. Now, number 5 is basically index fund investing versus mutual fund investing. And by the way, mutual funds are just another type of index funds, vice versa. Now, the idea is this, guys, okay? Mutual funds, they have one job, and their job is to go ahead, actively held ones, by the way, their job is to go ahead and try to beat the market. Index funds, their job is to go ahead and try to track the market. Now, one is very expensive and also costs a lot of money, and the other one is basically very passive and doesn't cost money or a lot of taxes. That one is basically index fund investing, because all you're doing is buying an index, for example, the S&P 500, and you're holding that, right? You're not selling back and forth or doing a bunch of trading, having a lot of taxes on top of that. The management fee or expense fee is only around 0.10%, while actively held mutual funds, well, they want to beat the market that involves a lot of trading, and that involves a lot of smart people. So basically, they charge you a ton of money, around 1 to 2% of your portfolio. And the fact is, if they actually do that, that could cost you up to 33% of your entire portfolio in the long run. So basically, that 1 to 2% is very, very expensive. On top of that, they have a bunch of taxes because basically, they're constantly trading and trading and trading, and that is going to cost you a ton of money. So obviously, if you want to be a passive investor, I recommend index fund investing. If you want to be an active investor, obviously I recommend value investing. Now give your money to a smart person to charge you a bunch of money, and before you know it, you basically just don't make any money whatsoever, because by the way, the average actively held mutual fund is not actually going ahead and beating the market whatsoever. Now, number 6 and number 7 and also number 8, a bonus here. I have to be honest here, I don't really have that much knowledge to it, and it's not games I would actually participate in, because basically they get so risky to the point where Peter Lynch doesn't understand it, Warren Buffett barely understands it, and it's very, very complicated. It's not a game I'm actually interested in. Now, that's basically option trading, basically trying to trade contracts back and forth. And on top of that, derivative trading, very complicated stuff. And lastly, commodity trading as a bonus. Now, these 3 things right here, these 3 things are not my game. Option trading, very risky. Derivative trading, very complicated. And on top of that, commodity trading is just not my game. I like to put my money into things that actually produce something. And I'm also a long-term investor, not for the short term or buying commodities and trying to short them and do all this other stuff, okay? But guys, those are 8 ways to go out there and become an investor and also make money from the stock market. But overall, I only recommend 2. If you want to be passive, do index fund investing. Very passive, low fees, and in reality, not that much taxes whatsoever. However, if you want to be Warren Buffett or whoever you want to be by picking stocks, I recommend value investing. And I recommend you go ahead and you read this book right here called The Intelligent Investor by Benjamin Graham, the grandfather of investing. And this book back here also by Charlie Munger, Charlie's Almanac, is also very inciting when it comes to the mind of an investor. But guys, overall, that is about it for this video. Comment down below and let me know exactly how do you want to get into the stock market. Do you want to be passive, index fund investing? Or for example, do you want to pick stocks and be a value investor? Or for example, do you want to take a lot of risks and go into option trading, shorting stocks, doing all the stuff, derivatives? Comment down below, let me know. And by the way, Tommy, but Warren does derivative trading with like investments and like insurance. That's a whole different game. And that's not really my game. And in reality, it's a little bit more complex than that, okay? And as always, guys, see you guys tomorrow. Thanks for watching. And if you guys like the video right here, guys, well, like this video. On top of it, if you're new here, subscribe and hit the bell so you're notified. And if you want to text me or talk to me one-on-one, join my Patreon, link down below, or send me a DM on Instagram at TommyBryson. And before I go, if you want to watch the full video on how I would go ahead and invest money or investing for beginners, here's that video right here. Click it on. I'll see you guys tomorrow. Thanks for watching, and as always, peace.